Dave, I want to start off with the dollar and what generally has been kind of the focus, the center of so much here in the market. Lower dollar has been tied to higher stocks. Some argue it's been tied to higher gold and maybe even copper too, commodities across the spectrum. How long and how far can it continue to the downside?
Hey there, Oliver. Thanks for having me back. Yeah, the dollar, that's the big question right now is everybody's bearish the dollar, everybody's bullish silver and gold, primarily silver. That's really taken the front and center for the last few days. In my estimation, the dollar is probably going to remain weak. We probably on a shorter term basis are a bit oversold. So, if you're not short the dollar vis-a-vis by being long the euro or maybe by being long the S&Ps, if you expect that correlation to remain intact, you'll probably get an opportunity in the next few days. But my overall view is the dollar will remain weak. But I am looking for a correction higher, let's say, over the next couple of days.
Does that mean the commensurate trade in gold is to the short side?
I think in the meantime, yeah, for sure. We've lightened up on our silver longs. We were long since late August. I'm not August, getting ahead of ourselves here. Late June. And, sentiment readings and whatnot, just getting a little too ahead of themselves, took a little money off the table. Silver's starting to pull back. Gold probably will pull back a little bit too. So I kind of see them all as basically one trade. If the dollar rallies a little bit, we're going to get some weakness in the euro. Certainly going to get some weakness in the Aussie dollar, Kiwi dollar, and probably in the precious metals as well.
How long?
Yeah, probably short term though.
Yeah, and just to be clear, I know that you've been on here before. You've been some of the stuff that you're saying to short now. It's not like you're some gold hater. You're not a gold bug either, I don't think. But, it seems like what you're seeing is these relationships that have been really strong. Will the relationships hold? So if we say, let's start with the assumption the dollar stops selling. It sounds like you think that means short gold. Does it go as far to mean short stocks because the two have been so inversely correlated?
I think that's a really tough one. And, some of the notes that I sent over earlier before our interview, it's just the way the markets are now. They have the dips, meaning the S&Ps will pull back. But as Nicole said right before she wrapped up her segment, they buy them back the next day. And I don't think that pattern is going to change a whole lot. The market structure's changed a lot over the last 5 and 10 years. And, there's just the drip, drip, drip of buying via index funds. And, other than hitting air pockets like we did in February and March, and, occasionally we'll get a 2 or 3% down day or 2 or 3% down series of days. The propensity is that money keeps coming into the market. It's indiscriminate. It's basically indexed. So I think you got to be really, really careful on being aggressively short. I think there's tactical trades on the short side for sure. But would I be bellying up right now and saying I want to be short the S&Ps because of COVID or any number of things? I think that's a tougher bet. I think you have to be pretty darn nimble in here.
What about if that money drip and the cash that we have seen still by just about every survey I see says there's a good amount of cash sitting around? What if it drips elsewhere? What if we see the lower dollar spur interest in companies and businesses out of countries that aren't still dealing with COVID as much? What about a Europe pickup? What about EM markets that have been gaining some ground?
Well, certainly that is a possibility. I mean, the monies could get redirected at any time, although I don't think it would be one of those things that would turn on a dime. It would probably be a little bit more of a gradual process. So I guess what I'm kind of saying is that I'm cautious. I'm not opposed to being short tactically, and I would keep my eyes open to exactly the things you're talking about in terms of flows, if you have that ability to do that. But until we see something like that taking place, it's kind of hard to get off what the current script is, which is buy the dips, sell the dollar, be long precious metals, and be long the risk-oriented currencies like the Australian dollar and New Zealand dollar. But I think you can play them both ways when the scenario's set up.
Dave, on the macro side, you've got a few charts. Usually you come loaded with technical charts and looking at points on prices, but I like what you've got today. It's a little bit more macro. I want to talk about them though, because liquidity in the market has been a focal point since our sell-offs, really going back to 2018 when things dried up in the kind of rate-driven sell-off. You look at this right now, the chart you sent over, is this implying that moves will be severe in both directions, or are we still going to expect big swings?
Yeah, I think until that, again, this chart is really, illuminates what traders are dealing with, especially if you're on, let's say, trading the S&P futures. They're very thin in terms of the bids and the offers. It doesn't take much to move the market. That's why you see such rapid gains and rapid losses. And that's been, as the chart clearly shows, that has been on a declining path for some time. So, maybe that's great from a trading perspective because you can kind of catch something quickly and sell it a few hours later or even a few minutes later. But the problem, as we saw back in March, is that when there is an abundance of sellers, there's not a big, deep pool of buyers on the bids. So you just quickly, almost like dominoes, just rifle through the bids when you're looking at an average of only 9 to 10 contracts on the bid based on that data. So the volatility is here to stay, and you're going to get those pockets of extreme volatility until that liquidity comes back. And quite frankly, I'm not really sure what would drive that liquidity back into the market because right now it's just been declining for some time and now just hovering around the lows.
Yeah. Okay, so liquidity could exacerbate the moves when we get
Absolutely.
them. Right now, you're kind of leaning towards the side that those moves in the short term could be lower. And there's also a chart here that I saw on a Bloomberg story as well this morning. I think it's a good one to bring up, which is basically tracking corporate executives, company insiders is the word, not insider trading, but it's folks inside the companies. When I first started learning about the stat, I was like, hey, what's going on here? How do we know the insiders? But the bottom line is the idea they know more about their companies than we would. And actually, they were a pretty good signal for when the market was going to roll over. So now maybe there's a signal that is happening again.
Yeah, again, there's any number of reasons why executives can sell. There could be tax reasons. They could, need money for, their new third or fourth home, any number of reasons. But, the general premise is that they're selling and or buying because of being opportunistic. Obviously, back in March, they nailed the low. They were big, aggressive buyers back then. Now they seem to be aggressive sellers. When you factor in what's happening, at least, at this point in time while we're talking, I could definitely see the possibility of a move lower in the S&Ps. And that data point is just simply that, one more data point in kind of the mosaic that I'm looking at right now. And frankly, we've been kind of just moving sideways. I mean, with a slight upward bias in the S&Ps, but we've been moving really sideways in 10-year notes. I would say the market's, in its summer, form right now, kind of dull. There's some moves here and there. And when that type of stuff starts to happen, you look at some of the clues that might serve as the catalyst for that next move that is, let's say, a bit more sustainable that you could trade on an ongoing basis. So that's where these charts that I sent over to you today kind of factor in. So I'm definitely leaning more on the bearish side right now. But as I said at the top of the interview, tactical at best. Maybe we get a few days, maybe a week. But again, trying to be steadily short in here is just not the call.